Fear came back into the market in a very big way. What began as a national problem in Greece has quickly metastasized.
Down 400 very quickly, and then down 800, nearly 1,000 in a heartbeat.
I mean, it is classic capitulation.
There are some people who are proposing there was some kind of fat finger error.
We have commodities that are being crushed.
There may have been a bad print in Procter & Gamble.
This is very much 1987.
Biggest single widening day since Lehman.
It was panic selling on the way down, and all of a sudden it just stopped on a dime.
Rallying back by 700.
This is all happening in real time, folks.
May 6, 2010. A normal day in the stock market until it wasn't. In just a few minutes, the Dow Jones Industrial Average plunged nearly 1,000 points. $1 trillion in market value vanished, only to rebound moments later. It was chaos. Traders panicked. Analysts were baffled. Regulators scrambled for answers. What could have caused this sudden collapse? Was it a massive sell-off, a cyber attack, or something entirely different? As investigators dug deeper, they found a surprising culprit: high-frequency trading, or HFT, an advanced lightning-fast strategy where computers execute thousands of trades in milliseconds. For years, HFT had been operating behind the scenes, reshaping financial markets. But the flash crash of 2010 was a wake-up call, a reminder that speed comes with risks. It was proof that machines could move markets faster than humans could react. The world of trading was no longer just about expertise and instinct. It had become a technological arms race. High-frequency trading, or HFT, is a form of algorithmic trading. It uses complex mathematical models and powerful computers to execute trades at speeds no human could match. Firms scan the market, looking for tiny price differences across exchanges. They buy and sell in microseconds, making profits before regular traders even see the price move. The core idea is simple: speed wins, slowness loses. To stay ahead, firms invest in cutting-edge technology, fiber optic cables, microwave transmissions, even AI-driven trading algorithms, all to shave off microseconds. The origins of HFT date back to the 1980s, when electronic trading first emerged. Over the next 2 decades, advances in computing and telecommunications accelerated its rise. By the 2000s, firms had developed ultra-fast algorithms capable of executing millions of trades per day. This revolutionized market dynamics, introducing both efficiency and new risks. Today, HFT dominates global markets, accounting for a significant share of daily trading volume. Before HFT, trading was largely a manual process. Brokers executed trades by phone or on the floor of stock exchanges. This changed with the advent of electronic trading in the 1970s and 1980s. The introduction of NASDAQ in 1971 marked the beginning of a new era. It allowed for computerized trading, paving the way for algorithmic strategies. By the late 1990s, the Securities and Exchange Commission, SEC, introduced Regulation ATS, Alternative Trading Systems, encouraging the rise of electronic trading platforms. This gave birth to the first HFT strategies, which leveraged speed to gain an edge over traditional traders. To execute trades in milliseconds, HFT firms invest heavily in infrastructure. This includes ultra-low latency trading platforms, co-location services, and advanced networking technologies. Some firms spend millions to position their servers closer to exchange data centers. This reduces the time it takes for trade orders to reach the market, giving them a competitive advantage. Additionally, firms utilize high-speed fiber optic networks and microwave transmissions to ensure faster data transfer between financial hubs like New York, London, and Tokyo. But this race for speed isn't without controversy. Critics argue that HFT creates an uneven playing field, where only the most technologically advanced firms can compete. Others worry about the systemic risks posed by ultra-fast trading, risks that became all too clear during the flash crash of 2010. The flash crash of 2010. 2010 was a watershed moment for HFT. On that day, the Dow Jones Industrial Average dropped nearly 1,000 points in minutes, only to recover just as quickly. At first, the cause was a mystery, but as regulators investigated, they discovered that HFT algorithms had played a significant role. During the crash, many HFT firms withdrew from the market, exacerbating the sell-off. This raised questions about the stability of markets dominated by machines. Could HFT algorithms designed to exploit tiny price differences also amplify market volatility? The flash crash forced regulators to take a closer look at HFT. New rules were introduced to prevent similar events, including circuit breakers that temporarily halt trading during extreme volatility. But the debate over HFT's role in modern markets continues to this day. While HFT has long been associated with traditional financial markets, its influence is now being felt in the world of cryptocurrency. The crypto market, with its 24/7 trading and high volatility, is a natural fit for high-frequency trading strategies. In the crypto space, HFT firms exploit price differences between exchanges, a practice known as arbitrage. For example, if Bitcoin is trading at $30,000 on one exchange and $30,050 on another, an HFT algorithm can buy on the first exchange and sell on the second, pocketing the difference in milliseconds. But the crypto market also presents unique challenges. Unlike traditional markets, crypto exchanges are decentralized and often lack the regulatory oversight of established financial systems. This has led to concerns about market manipulation and the potential for HFT to exacerbate price swings in an already volatile market. Decentralized finance, or DeFi, is another area where HFT is making waves. DeFi platforms allow users to trade directly with one another, without the need for intermediaries like banks or brokers. This has opened up new opportunities for algorithmic trading, including HFT. On decentralized exchanges, HFT algorithms can execute trades directly on the blockchain, taking advantage of price discrepancies across different platforms. But DeFi also introduces new complexities. For example, the speed of blockchain transactions can vary depending on network congestion, making it harder for HFT firms to maintain their edge. Despite these challenges, HFT is becoming increasingly common in the DeFi space. Some experts believe that as DeFi grows, so too will the role of HFT, raising questions about the future of decentralized trading and whether it can remain truly democratic. The rise of HFT has sparked intense debate over its legal and ethical implications. Critics argue that HFT gives an unfair advantage to large firms with the resources to invest in cutting-edge technology. They also worry about the potential for market manipulation, such as spoofing, a practice where traders place fake orders to create the illusion of demand. Regulators have taken steps to address these concerns. In the United States, the SEC has introduced rules to increase transparency and prevent abusive practices, but enforcement remains a challenge, especially in global markets where regulations vary widely. Meanwhile, proponents of HFT argue that it improves market efficiency by narrowing bid-ask spreads and increasing liquidity. They also point out that HFT has become an integral part of modern markets, and that attempts to restrict it could have unintended consequences. As technology continues to evolve, so too will HFT. Advances in artificial intelligence and quantum computing could take algorithmic trading to new heights or depths, depending on your perspective. Some experts predict that AI-driven HFT algorithms will become even faster and more sophisticated, potentially reshaping markets in ways we can't yet imagine. At the same time, the rise of decentralized finance and blockchain technology could challenge the dominance of traditional HFT firms. In a world where anyone can trade directly on the blockchain, the playing field may become more level, or it could become even more fragmented. One thing is certain, the story of HFT is far from over. As markets continue to evolve, so too will the strategies and technologies that drive them. And as we've seen, the stakes are high, not just for traders and investors, but for the global economy as a whole. High-frequency trading has transformed the world of finance, bringing both opportunities and challenges. It has made markets faster, more efficient, and more interconnected than ever before. But it has also raised important questions about fairness, stability, and the role of technology in our lives. As we look to the future, one thing is clear: the speed revolution is here to stay. Whether it leads us to a brighter future or a more uncertain one depends on how we choose to navigate the challenges ahead. In the end, the story of HFT is not just about machines and algorithms, it's about us. How we adapt, how we innovate, and how we ensure that the markets of tomorrow serve the many, not just the few.